Hi, good evening, ladies and gentlemen. Welcome to today's webinar session where we share about CPF and also SRS and whether they should or should not be utilized for investments. So this is actually the second installment of our Personal Finance 101 series of webinars. So do continue to keep a lookout for upcoming webinars on our website as well as our e-newsletters. So for this evening's session, we have Ko Yang Zi, Investment Advisory Team Director at iFAST Global Markets, and Sean Tiao, Senior Unit Trust Analyst at SM1.com Singapore, to explore the pros and cons of investing your CPF and SRS monies, but more importantly also whether you are suitable to invest via these methods and how to get started. So at the later part of this session, we will also share some CPF related resources and tools available on fsm1.com that can be beneficial for your investments. So meanwhile, if you have any questions, you also can feel free to use our Q&A function on this Zoom to type up your questions, and we'll be happy to answer them later during the Q&A session. So without further ado, please welcome our first speaker, Yang Zi.
Okay, thanks, Sarah. And thanks everyone for joining us in this webinar today. I hope you all had a good evening so far. So I believe now is tax season. So a lot of people will be thinking, at this point in time, should I be topping up my CPF? Should I be topping up my SRS? And also, if I'm going to top up my CPF and SRS, should I actually be investing these monies or not? So these are some of the questions that we will be exploring today. Okay, so a little bit of a Sorry, let me just move it to a full screen first. Okay, so a little bit about myself. My name is Yang Zi. I'm a Team Director of Investment Advisory at iFAST Global Markets. Currently, I'm managing over 30 million of AUA. I'm about more than 5 years in this field, and I'm a believer of goal-based investing. As to what is goal-based investing, right? That is a topic for another day. So if you're interested, you can chat me up. Okay, so back to the topic, okay, of SRS and CPF. Should you invest? So before we even start thinking of whether or not we should invest, right? Let's explore, what you can actually do with this CPF OA, CPF SA, as well as your SRS. So you can decide whether or not you want to top up. Okay, so if you are Singaporean or a PR, right, by default, you already have, this enforced CPF contribution on a monthly basis whenever you get your income. So for your CPF OA, it actually gives you a fixed 2.5% per annum interest. So what the CPF OA can be used for, it can be used for your retirement. So when you hit 65 years old, that's when you start getting your CPF life, okay? So it helps with retirement. Of course, I think the most common use of CPF OA is to purchase your property. And of course, another thing that you can use your CPF OA for is actually your children's education, okay? For CPF SA, it gives you an interest of 4% per annum, and it can be used for retirement. So similarly, when you turn 55, right, you will have this new account in the CPF called a CPF RA, retirement account. So your OA monies, SA monies will all go to the retirement account. And then at age 65, that is when your CPF life kicks in. Okay, so when we're talking about, tax season, right, whether you want to contribute over to your, contribute to your CPF, right, you can actually contribute $7,000 to yourself and $7,000 to your loved ones for tax relief for CPF. And then moving on to SRS. SRS actually stands for Supplementary Retirement Scheme for those who are not aware. So for SRS, it gives you an interest of 0.05% per annum. So it is pretty unlike CPF where it is enforced. SRS is a voluntary scheme, meaning that not everybody will have an SRS account. But if you are looking to open up a SRS account, right, you can just open it with any of the local banks. And the SRS accounts, what is it used for? Is basically for retirement. So assuming you are, let's say, 35 years old today, 40 years old, okay, you are working and you're contributing. The maximum limit is $15,300 every year. So assuming you're putting in $15,300 every year, at the retirement age, which is set at 62 at the moment, you can start drawing down from your SRS. So SRS is primarily used for retirement and tax planning. Okay, so what exactly does we always talk about, SRS, tax planning, should I contribute? So what does it actually look like? Okay, so this is an example to illustrate what tax relief looks like in the actual space. So if you intend to contribute SRS, you have to do it by the 31st of December. So here's an example. Let's just say today, in this year, in 2020, your annual income is $135,300. Okay, and you decide that today, let's contribute 15,300 to my SRS. So that leaves your chargeable income. It sets your chargeable income at $120,000. Okay, so what it does is SRS actually reduces your overall, chargeable income. So how much? Here's an illustration of how much tax savings you actually have. So you look at this table I actually got from the IRAS website. So after this webinar, if you're interested, you can head over to the IRAS website to have a look at this table. You might be earning more than 160,000. So you might be wondering, so what kind of tax am I paying? So you can head over to the IRAS website to have a look. But let's just go back to our example. Assuming you are making $135,300 this year, okay, the amount of tax you'll be paying this year for this year's income would be $7,950 plus $2,295. So that adds up to slightly above $10,000. So how do we derive this, right? You look at this table, the first 120,000, the amount of tax you have to pay is 7,950. And then the next 40,000, you would have to pay a tax of 15% on whatever the amount is. Okay, so that's how you derive that 10,000 plus tax that you have to pay based on this income. So this is without SRS, without the CPF top up that you are doing. This is the full tax that you'll be paying. So assuming today you said that, okay, let's save some money, let's top up SRS. Okay, so when you do that, you top up 15,300, your chargeable income is reduced by 15,300, which means that your chargeable income is now $120,000. Okay, so when you do this, right, you realize that you will only be paying tax on this first $120,000, which means you'll be paying a tax of 7,950, but you would essentially save $2,295 in tax. Okay, so it's a great way for you to get some tax relief and pay lesser tax. So if you think that this tax savings is good, right? Here's the good news: is that you not only can enjoy tax savings, you can also invest your SRS. So the question today, right, we'll be exploring is more of yes, you can invest, but should you invest these SRS monies? If you're going to top up your CPF or your existing CPF, additional CPF OA monies, additional CPF SA money, should you be investing your monies? So these are some of the things that we're going to explore in the slides later. Okay, so to answer this question, right, in most cases, yes, you should be investing. Okay, so I'll be sharing with you why and why not, who should be investing, who should not be investing. Okay, so the obvious reason why you should be investing, right, your SRS monies, your CPF monies, is because of the potential to outperform. So if you look at this chart over here, it's just a very simple illustration. It is just a 5-year. This is just a 5-year chart, and I'm basing it. You see in the yellow line over here. This is based off this fund called a very strong performing fund called First Sentier Bridge. Some of you may know it as a First State Bridge. So recently they changed the name to First Sentier Bridge. So it has given pretty strong returns over the past 5 years. And as you can see over here, right? Okay, this is just annualized returns. The actual graph actually doesn't look so straight, but this is annualized returns. If you are able to hold for 5 years, you actually have the potential to significantly outperform the CPF SA, which is in the gray line, or the CPF OA in the orange line, and SRS in the blue line. Okay, so at this point in time, you must be thinking then, in that case, right, should I just plow all my monies into this First Sentier Bridge if it's so good, right? So the answer is no. Okay, so we should not just based on this presentation say that I'm going to buy this fund and I'm going to put everything into this fund. Okay, so So I'm going to start off with, who should invest and who should not invest. So if today you are contributing to your SRS and then you're thinking, should I invest or not, right? Here are the three things you need to first take note of. So if you want to invest, you need to first have an investment horizon of more than 2 years. Okay, because the average recession lasts about 11 months. Okay, so some examples are, let's just say today I'm making a CPF OA investment. Okay, and then I'm waiting for my BTO. My BTO is coming in 1 year or even 6 months time. So in that case, right, it may not be very suitable for me to be investing these CPF OA monies that I need for my upcoming BTO. Or let's just say, today you're investing on SRS. You'll be thinking, SRS, would there be a case where I, don't have 2 years horizon? Because, SRS is 62 years old, then I can touch my right. So by right, you should have a very long horizon. That is for most cases, but in some very rare specific cases, you may be drawing down from age 62, and then you have to draw down for 10 years. So assuming today, right, you are already at age 71 already, so you have 1 more year before you draw down your full SRS savings, right? Then you may not be suitable to be investing these SRS monies. For all other cases, right, yes, you should consider investing. Of course, the second thing is that you need to have tolerance for volatility, meaning that because markets don't go up in a straight line. So I think in the earlier slide, you see that, the outperformance, everything looks very good. But as we all have experienced during the February and March of this year, anything can happen. The markets go up, the markets go down. So if you are overly worried about this volatility, right, it's something that you probably have to take into consideration. Of course, the third thing is you have to be willing to do the due diligence, because not all investments are equal, which I'll show you a bit later. Okay, so now for investment horizon, more than 2 years. So what I did over here was that I pull out all the recessions in the past 100 years. Okay, so there's the Great Depression, there's the post-Korean War, and then the most recent one in year 2001, we have the September 11. And then some of you will remember the dot-com bubble, and then in 2008, you have the Great Recession, which is, some people call them the Lehman Brothers crisis, some people call it subprime crisis, some call it mini bond crisis. And then February and ongoing, we are actually experiencing the COVID recession. So if you look at, all the recessions in history, right, the average period lasts about 11 months. So the worst time to be drawing down from your investments, right, will be during an economic downturn. So, and that's why as an investor, it is important that you have a longer horizon. Then secondly is that you have to have a tolerance for volatility. So I'm using back the same example over here, First Sentier Bridge. You can see that, even though that, over 5 years, it managed to significantly outperform, CPF SA, CPF OA, and everything else, the SRS, it is not always rosy. So you just look at this chart, there are periods whereby, the fund actually dips in value. So in the first box, you see it is a dip from August 2018 to February 2019. I believe that was because of the escalation of the trade wars between US and China. And then, the recent one, February until June, there was this period of the fund not doing so well because of the COVID recession. So if we are an investor, we should expect that there will be times of volatility like this, and we need to have the ability to continue holding despite this volatility. Because if you sold off during this dip, right, what happened is that you would realize the loss, and basically you will not make the returns, and you will not be able to outperform your CPF rates and your SRS. Of course, then the third one is the willingness to do due diligence. So I just put out some funds over here. So since I've been talking a lot about First Sentier Bridge, right? Look at the fourth one, that's First Sentier Bridge. FSM says good. You see the red sign over there. Yeah. So if you look at the 3-year and 5-year annualized return, right, it's giving a pretty decent return of 6.86% annualized, or 5 years is 7.76% annualized. But if you look just one row below, there is a fund that the 3 years annual return, and it's giving 1.12%. Okay, whether it's a good fund, not a good fund, and stuff like that, we're not here to discuss. But what I'm sharing with all of you is that not all investments are equal. So it is important that today, if you are going to invest your monies, it is important to do the due diligence and understand the strategy of each fund. Because if you're going to get 1.21%, you may as well put the money inside your CPF OA and get the 2.5% fixed. Yeah. So the whole idea of investing is that you want to outperform the existing rates that you are receiving. Okay. So assuming that you fulfill all these conditions, and then you say, yes, I should be investing. I have more than 2 years horizon. I'm okay with volatility. I'm willing to do my due diligence. What's next? Okay. So assuming I top up $15,300 into my SRS already. So then I'm thinking, so what should I buy? Should I buy stock? Should I buy unit trust? Should I buy ETFs? What should I buy? So here's 4 questions, right? Four questions that you can start asking yourself to help you make this decision. Okay, this is a framework that you can follow. So the first one is risk profiling. So in risk profiling, you ask, what kind of investor am I? Am I a balanced investor? Am I an aggressive investor? Second question is basically, the second thing is portfolio construction, meaning that after you understand what kind of risk profile you are, what kind of investor you are, then you start building your portfolio according to your risk appetite. The third thing is basically investment selection, meaning that you need to decide, so I've decided that this portfolio is going to be this level of aggressive. What do I pick? And the last one is what I call risk premium assessment, meaning that you need to, after you construct your portfolio, you need to have a look at the, what's your target return, how much you're thinking this can generate. And then you can ask yourself this question, I'm going to take some risk by buying all these investments. Is it worth it or not? Okay. So I go a little bit more in depth into all this. So what kind of investor am I? That's risk profiling, right? So it's difficult to say, I'm aggressive or I'm conservative. How do I actually judge? You judge by 2 factors. The first one is your ability to take risk. So the ability to take risk, right, is a measure of the amount of assets you have versus the amount of assets that you invest. So assuming today I have $1 million and I'm just investing $10,000. So my ability to take risk is very high because it is just a very small fraction of my total assets. But today, if I have $10,000 and I'm deciding that, I'm going to invest all $10,000, then my ability to take risk is not that high because that's everything I have. I don't want to lose that money. So the first thing is your ability to take risk. The second thing is your willingness to take risk. So you can have $1 million and then you're just investing $10,000. But if $10,000, right, goes down by like 10% and then you cannot sleep at night, right? Then perhaps that investment is not very suitable for you. So the second factor is basically your willingness to take risk. So I think the ability to take risk and the willingness to take risk is something that every investor has to make their own individual assessment as to where they are. So if you see below, there's a line over there. On the left is conservative, on the right is aggressive. So based on your ability to take risk and your willingness to take this, you have to decide, on which spectrum am I? Am I conservative? Am I like somewhere in the middle? I'm balanced, or am I an aggressive investor? Then after you have determined what kind of investor you are, then you have to decide, okay, so what's my portfolio going to look like? What's my portfolio going to look like? So if you're a conservative investor, okay, before I even move to that, so one of the common mistakes that investors do is that whenever they have a certain amount of money, right, basically they just take, let's say, 15,300. They'll take the full amount and then they just buy into one fund. So the thing is this, when you build a portfolio, it is not necessary that, I have to just buy one fund. Okay, $15,300. You can actually split it into 2 funds, 3 funds, 10 funds. It depends on how you want to build your portfolio. Okay, so over here, I'm going to illustrate a little bit more about what I mentioned. So if you're a very conservative investor, you can look at fixed income funds. So fixed income funds, these are less volatile investments. So they are buying into bonds, okay? And then usually you expect a steady growth in this kind of funds. So they can give you, 1%, 2%, 3% annualized. So you think of it as, conservative investment. You're driving your Japanese car, Toyota, that is very steady and, slow and steady wins the race kind of investment. And if there's any breakdown, right, you know that the repair is not going to be overly expensive. Then on the rightmost are the aggressive investments, meaning that these are the equity investments. So you're buying a lot into like things like the stocks, you're buying into companies. So usually these are more volatile, meaning that it goes up and down a lot more, but it is also more high performance, meaning that it has high potential to outperform, your CPF, SA, CPF, OA rates. Okay, so think of it as, as compared to your Toyota, right? This is like a sports car. This is like your Ferrari. It is high performance. It can go very fast. But today, if your Ferrari is going to break down, it's going to be very costly for you. Okay, so this is how we think about it. Of course, you may not be, at the ends of the spectrum. That means you may not be conservative or aggressive. You might be a balanced investor. So that's when you may consider, how about I do 40% fixed income, 60% equities. So this is something that you can mix and match according to your preference. So what happens is that this portfolio, right, has to reflect your risk appetite and your preference as an investor. So after you decided, okay, 60-40, what next? That's when you go into the investment selection. So 40% into, let's say I have $10,000, 40% is $4,000 into fixed income, $6,000 into equities. Then you have to ask, the next thing is, what is my strategy? What is my strategy? Okay. So within a fixed income space, what kind of fixed income am I going to buy? Am I going to play it safe and buy, investment grade bonds only? Am I more adventurous to look at, high yield bonds? So what kind of fixed income do I want to buy? Then in terms of equities, you'll be like, which sector, which region do you want to look at? Do you look at Asia, US, Singapore, China? Where do you want to position your assets? So as a rule of thumb, because some of these can be a bit confusing, but I think in the second part of the webinar, my colleague Sean will be sharing a lot more insights as to how you can actually select all these good investments. But as a rule of thumb over here, the less you know, the more you diversify. So assuming today I want to invest, but I'm not very sure how I want to be investing, right? The best strategy would be to diversify as much as possible. So I will buy into basically as many different sectors and regions as I can. So I basically buy the world. Okay, so that is how you approach it if you don't know how to start. But if you start doing more homework and then you start reading into Asia, Asia seems to be poised to recover from COVID. I think that Asia is good. And you're confident about it, that is where when your conviction in a certain region or conviction in a certain sector increases, you can actually diversify less, meaning that you put more eggs in that basket, saying that I think this area is, I have more confidence, so I'm going to put more there. Yeah, so that's the general idea of how do you actually select. Then, of course, the last part over here, right, is you need to do an assessment of this risk that you are taking. Is it worth or not? So assuming you construct your portfolio already, and you're saying that, I'm actually a kind of like conservative to balanced investor. So I'm somewhere in the middle. I'm moderately conservative. So I'm picking a lot of fixed income funds, and maybe a little bit of equities. And then, historically, this portfolio, if I do some back testing and I see, okay, it gives me about 3.5%. Then of course, we shouldn't be investing your CPF SA into that. So if you do some back tests and then you see, this can give me about 5% returns. So you have to ask yourself this question, 4% risk-free returns, okay, not entirely risk-free, but close as possible to that risk-free, versus a 5% potential return. So it is something that as an investor, you have to make the judgment call to say, is it worth it or not? Because to some, they may think that it's not worth the risk, but to others, they may think that, yeah, I'm just going to do it. So it's a very individual choice. But I think the question becomes a lot simpler when we're talking about SRS, because the rate that we're trying to beat over here is 0.05%. So in fact, if you just screen through any of the funds, right, you will realize that it is, as long as you have a good enough horizon, it is not difficult to beat the rate of 0.05% per annum. Okay, so this is the end of the first part of the webinar. So thank you all for your attention. In the later part, right, my colleague Sean will be sharing more about how do you actually pick these funds. But in the event that you have you sit through the whole this part one of the webinar already, and then you find yourself more lost than understanding more clarity, right? Feel free to chat me up. I will just leave this QR over here. You can snap a picture or anything. If you want to have a chat with me, just scan this QR and you can get in touch with me directly. Okay, yeah, so thank you for attention. So over to you, Sean.
Okay, thank you, Yang. So just give me a moment while I set up my presentation slides. Yeah, so I think Yang Tze gave all of you a pretty good overview as to whether you should invest your SRS and how it has and how it can actually save you some tax monies as well. But for this part of my presentation, I'll be mostly going through like three things mainly, really, just to firstly introduce to you our CPF microsite, which is titled Set for CPF. It's a microsite where we have some of the tools and features that you can actually use to help you understand more about investments, as well as some of the key things to note when it comes to your own investor psychology. So we have insights and stuff like that, which I'll go through with you later. And the second part of the investments is to really help you understand our platform and as to how you can actually use it to look for CPF and SRS enabled funds, to look for funds, and also how potentially you can actually build your own portfolio with a framework. So I think previously Yang Tze shared with you conceptually how you can look at it. So I'll be giving you like a very simple example as to how you can approach it. And last but not least, I'll also be going through this topic of what if right now this is the market top, right? And how you can actually approach this with I think with RSP strategy, which I'll be sharing with you about. So just to start along, I think for CPF, I think why we actually created this microsite, because we believe that we want to basically provide this dedicated platform to give you the relevant tools to help you plan, to help you give you ideas with regards to products, and also the knowledge to help you achieve your retirement goals, right? Because our goal eventually is to help investors to become profitable and help them invest globally to the best ideas, gain access to the best ideas. So I'll just be roughly going through with you what this microsite would be. So first and foremost, it is a learning hub for all of you to actually access. So you will gain insights relevant to financial markets, CPF, personal finance, and more, right? So this is a place where you would understand some of the basics of investing and perhaps how you can think about planning your own financials. So another thing about what CPF, Set for CPF is that we want to make it a gateway for investment ideas and perhaps strategies. And hopefully these will help you prepare your CPF portfolios for what's ahead, whether or not you should rebalance, whether or not you should maybe gain a little more exposure to a certain market, stuff like that. And thirdly, we also hope to make it like a portal for fund updates. So this is one area where you can actually get direct access to updates for CPF funds when they become available, when they're made available to us by the fund houses. So all in all, I think to sum everything up, we want to provide you with the tools, the products, as well as the insights so that you can make more informed decisions when it comes to investing. So this is how the page will look like when you first enter this microsite. So this is accessible through our main FSM1 website. And when you click on it, this is how it will look like. So if you look at this part where it's called, where it's maximize your CPF, it's basically an introductory page for you. So if you scroll down further, you can actually see this retirement calculator. So this is one of the tools that you can actually access with the microsite, because I think the first step to any long-term investment plan is to knowing how to get there. And knowing how to get there, you basically have to know yourself. So you have to come to terms with what's your investment horizon, what's your desired retirement sum, and also your risk profile, so that you can actually make a good financial plan, something that you can stick to. And if it's something that you can stick to, it's likely that your investment outcome will be more successful. And I think you can play around with this calculator, but I think generally speaking, if you need some guidance on what are the parameters for certain things, like for example, the rate of return or maybe the inflation rate, you can actually refer to what I've actually pointed out in this point form, rate of return about 4 to 6%. I think that's a great conservative return and is realistic. And I think inflation rate wise, maybe about 2 to 4% right now, given this interest rate environment that we're in. I think if you extrapolate out, I think 2 to 4% is quite conservative. So all in all, so this is one tool that you can actually use to help yourself with financial planning. So if you go to another another portion of our website, we call it the starter kit. So this is actually one way that we hope to actually help you get started with investing, and this relates mostly to portfolio construction and asset allocation, right? So asset allocation basically means that you have to create your own portfolio. First, you look at your portfolio mix, equities versus bonds. Then within this mix, perhaps like how can you look at things? So this is again a very simple calculator with predefined numbers in the allocation box over here. Like as you can see, US equity is predefined as 25%, Asia ex Japan 30%, so on and so forth. So this is roughly in line with our GDP weighted approach. But ultimately, we believe the decision lies with you. So you can actually change the parameters inside. And so what this does is basically, based on these parameters and based on the funds that you choose, it basically spits out the amount of money that you need to invest minimally, that you minimally want to transact, that you minimally need to transact, right? So this actually gives you a very good idea of how much money you need based on the parameters that you choose and the funds that you pick. So at the end of the day, I think this our goal is to ensure that investors who are starting out have a diversified portfolio to start with. And another part of this website is basically insights. And we hope that over time, we will be introducing content, things that are relating to perhaps the 101 of investing, and maybe some retirement or CPF insights. Maybe if there are changes to, for example, some of the CPF rules and how would it affect, it will all fall under this part. And again, like I mentioned earlier, if there are any updates for any particular CPF fund, it'll be over here as well. And some of the more, I would say, different thing would be sometimes on and off. We will have maybe some articles relating to some of our in-house investment views, as well as asset allocation ideas that is relevant to CPF funds. So, for example, in recent times, we actually put out an idea on Asian small caps, and we have I think for CPF approved list, there is an Asian small cap fund. And I believe it's by PineBridge. So these, from time to time, you will be able to find ideas like these posted on these on the website. So I think I've introduced to you what the microsite is, but perhaps I also want to clear the air as to what it is not. So first and foremost, it is not a managed portfolio solution. Ultimately, it's still a DIY platform for you to actually invest it with. But of course, with the tools that will hopefully supplement your investment decision-making process. And number two, I think we do not actually charge any fees with regards to CPF investing. So all these funds, whatever you invest in, we actually do not take a cut out of these fees. So, and lastly, number three, this is not a digital advisor. So if you do need advice on how you should approach your investments or how you should do your financial planning, ultimately you will probably need to go to a financial advisor or head on to our main website where we have investment advisors to actually speak to you with. So I'll just move on to the next part about the CPF or SRS funds that are available on our platform. So this is the list of funds. I mean, like a very broad overview of the CPF approved funds on our platform. So of course, this is limited to what CPF approves, what they allow in terms of the funds to be available for purchase on the for CPFIS. So at the moment, we roughly have about 41 equity funds, 11 fixed income or short duration funds, 4 balance funds, and about 2 two funds that we consider to be alternative investments. So they are, most of the time they tend to be multi-asset funds. And of course, you can get access to a wide range of fund houses, some of which I think most of you are familiar with. So the First Sentier Bridge that I think Yang Zhi mentioned earlier, which is basically First State Investments. I haven't changed the logo, but it basically it's a First Sentier Bridge, First Sentier. So I think when it comes to SRS, your options becomes much wider, right? So on our platform, you actually have more access to more than 800 choices to choose from, and that of course it's of various share classes. And for ETFs, you also do have some choices, but it's relatively limited. You have about 20 funds choices available, and that also includes the newly launched Lion OCBC Hang Seng Tech ETF that's listed on SGX. So how you can actually look at what SRS enabled funds there are, you can actually simply use our fund selector available. It's basically like a filter for you to filter out funds. So you can actually do it across categories, specialist sectors, geographical regions, and even currencies. But just to give you a very broad overview as to the type of SRS funds available, you can actually go to the payment method and filter for SRS. So when you do it, you can actually you will see like a wide range of funds available. So as you can see from this red color box over there, you can see that 1 to 25 out of 870 entries. So there's 870 funds for you to choose from. And of course, over here, you can group them by various metrics, by risk-adjusted returns, year-to-date returns, even dividend yield, which falls under the info table. So if you do want to have some, if you have no idea what funds to invest, you can actually somewhat rely on the recommended funds list, because we do have some recommended funds which are SRS enabled. And to do so, again, just head back to the filter, to the fund selector, and you just have to put on the checkbox which says Fund Supermart recommended funds only. And when you do that, again, you will see the same thing, but this time around, of course, you have much lesser choices to choose from. But all these funds actually go through our rigorous fund methodology choice. I mean, like how we look at funds. So all in all, when we look at recommended funds, when we recommend funds to investors, we always look at it from a perspective of risk-adjusted returns. So sometimes, perhaps some of the funds may underperform in terms of absolute returns, but our focus really is about risk-adjusted returns, and we do have choices, 32 of them out of the 870 fund choices that you can actually choose from. And if you do want more information about these funds, we actually do have write-ups on them. You can click on the funds, and I think over there, there'll be a tab for you to click on, which is fund write-up. And that's where we go into slightly more detail about what the funds are and how it compares to some of its peers. So I think generally speaking, from my perspective, the type of funds that are suited for SRS investments, because from my perspective as a millennial, I see them as a long-term contribution to your retirement. It's something that I probably do not want to take out because I don't want to be liable for the tax penalty. So I see it as something as a much longer term type of investment horizon, right? So for me, if I were to invest my SRS monies, I would want to go perhaps take a slightly riskier approach because time is on my side, and there's a lot of opportunities for my monies to actually grow, even if let's say there's a large dip ahead of us, right? So for me, I will be looking at it from an asset class perspective. I'll be more biased towards equities because I mean, it really depends on how you approach your investment planning, right? So if you have a large sum of money in your CPF OA or SA, you know, I could see it as your safe harbor. It could actually form as your fixed income, your fixed income portion of the portfolio, and maybe your SRS could be something that's more risky. But again, I digress. This is something that I think you have to decide, and how you view your overall financial planning. So conceptually, I think Yang Zhi has already shared with you how you can approach thinking about portfolio construction. So I'll be giving you an example of how you can do that. So after you've decided on your portfolio mix of, let's say, equities versus bonds, let's just dive deeper into, let's say, how you can allocate your monies according to your equities, right? So this is just an example of how you can look at things. So firstly, you have your neutral weight, your current weight, and your stance. So your neutral weight would be based on, for example, your like a particular approach that you adhere to. So for this case, we'll be looking at it from a GDP weighted approach, right? So these are the various neutral weights based on the region or the countries, and then we also have the current weight, and this is actually relates directly to our stance, or rather our near term or medium term market view towards the particular region. So sometimes we do want to keep it neutral, we want to underweight, or we want to overweight. And to express this view, sometimes we would change the weightings of how we allocate to these equity markets. But of course, this is not something that you have to do. But if you do want to add value, or if you do want to have a greater control over your investments, this is something that you can do. And the same goes for fixed income markets, because like equity markets, there are different fixed income segments across the fixed income universe, right? So, for example, we highlighted in this example, for perhaps you want to consider Singapore-centric bonds, global bonds, Asian IG bonds, even emerging market bonds, as well as high yield bonds. So, of course, all these have varying risk levels. And again, they have neutral weightings that we actually allocated to these areas. And because we always approach fixed income portfolios as something that can anchor your overall portfolios, and therefore we actually tend to have this greater weighting towards your safer bonds, which are your Singapore-centric bonds. And again, we have this current weighting and current stance. And yeah, so I will not be going through further, but this is overall an example of how you can actually approach creating your portfolio from a practical point of view. And yeah, so just to continue on further on the line as to how, for example, you want to construct a portfolio based on, let's say, whatever that we did. So if you want to equal weight all your regions, this is how roughly what your initial outlay would be, and which would be $8,000 across 8 funds. And if you do want to have a regular savings plan, so this will cost you about $800 per month out of your SRS accounts. and likewise for your fixed income markets. So the thing about investing is that, you don't just do it and just forget about it, because from time to time, markets perform differently. I think what Yang Tze said was true with regards to markets don't move up in a straight line, and even more so for equities and bond markets, because they tend to move differently. And the thing about this is one asset class could outperform for a significant period of time, and that's when you must actually rebalance your portfolio periodically. And the idea of rebalancing a portfolio is basically to take money off the table in areas that have outperformed, or where actually valuations have become too high, and the reason why is because markets don't move in a straight line, right? You want to take money off the table in areas that have outperformed and reinvest in areas that have underperformed. And so hopefully this can actually improve your risk-adjusted returns, reduce your portfolio risk over a long investment horizon. But of course, this is something that, again, you have to do it yourself. You probably have to open up an Excel sheet and go through how your weightings have actually diverged away from your original weightings that's in line, again, with your risk profile. So I think we have spoken a lot about about how you can actually use our platform and look for funds, and how you can construct your portfolio with the funds available on the platform. So I guess a lot of things that are at the top of everyone's mind is that, okay, markets have risen quite a fair bit. So what if I invest now and it happens to be the market top? So I believe history will offer some clues to our question. So if we look back into the past, into periods where I think we have experienced massive drawdowns in equity markets, be it in the Great Depression era or be it in the World War II era, right? So in the Great Depression era, I think from top to bottom, if you, let's say you're so unlucky that you actually invested all the way to the top, you would have experienced like a 86% in drawdowns from top to bottom. And in terms of price, it would have taken you about 25 years to break even. And the result is also slightly similar in the World War II era, even though of slightly lower magnitude. In World War II, you have experienced about 58% in drawdowns. But for example, if you actually engaged in a regular savings plan, if that was an option, if that was a thing back then, right, you would have actually reduced your maximum drawdown in terms of your portfolio value to just 67%. And in terms of breaking even from your lowest point, right, it will only take you about 13 months to recover from your lowest point. So again, it's a similar thing for your portfolio. If you had RSP during the World War II era, your maximum drawdown would have been about 31%, and it would have taken you about just 7 months to recover from your deepest loss. So more recent global events for context, right? So if you look at, let's say, the tech bubble, which I think was one of the major bubbles that perhaps some of us have lived through, it would have taken you, in terms of price returns, you had experienced a drawdown about minus 46%. And if you had an RSP strategy ongoing, just minus 28%. And I think the more important thing to note is really the months to recovery to back to break even, because I think a lot of what goes on in investment sometimes is actually our own psychology, right? And I think the application of regular savings plan would definitely have resulted in lesser pain and shorter time spent in agony, because sometimes when you see such large drawdowns, it becomes very difficult to sleep at night, right? And I think this regular savings plan that you engage in can lower your drawdowns and reduce the time for you to actually recover your investment capital. So it's something that you actually have something less to worry about. So the thing about regular savings plan is that why it works is because when markets go down, you actually acquire more units. You actually acquire more units when it goes down, and actually less when you go up. So you're buying, in a way, more when markets are going down and buying less when markets are going up. So I think I'll just take this opportunity to step in some marketing message for some of the ongoing promotions that we have for SRS. So if you go to our main website, you might be able to see this promotion that's ongoing right now. So we are offering some incentives for SRS investors, be it new or existing ones. So for new investors, you will be receiving $20 in FSM1 multi-currency cash for every $10,000 that you invest in. And of course, this is capped at $100. So if you invest $50,000, you'll be able to receive up to $100 for new investors. So for existing investors, the incentive is slightly less, but we still have something for you. So you would receive $10 for every $10,000 invested, and that's capped at $50. And on top of that, we do have a special bonus for the top 20 SRS investors during this promotional period. So on top of whatever you are receiving, you'll be it whether you're a new or existing investor, you would also receive $20 in cash credits for every $10,000 you invest, and this is actually up to $200. So, for example, if you're an existing investor, if you already had 50,000 in SRS, and let's say you decide to invest 100,000, this special bonus will only take into account this 100,000 that you of fresh monies that you actually bring in. Yeah, so I think that's all I have. We'll be, I think, moving on to the Q&A portion. I'll just bring it back to you, Sarah.
So with that, we've come to the end of the presentation. We hope that you enjoyed this time and, it has been an insightful session for you. And we'll just leave the Zoom on for a short while so you can copy and paste the relevant links. And with that, thank you for joining us and have a great evening.